Life insurance is not really about the person who dies. It is about the people who still need money after that person is gone. Term life insurance is the simplest version for many families because it covers a specific period of risk. Term life insurance provides a death benefit if the insured person dies during the policy term. The term might be 10, 20, or 30 years. If the person outlives the term, the coverage usually ends without a payout. The main purpose is income replacement. If a parent, spouse, or business partner dies, the death benefit can help replace lost income, pay debt, cover childcare, fund education, or give the family time to adjust. Income replacement is not only about salary. A stay-at-home parent may provide childcare, transportation, household management, and emotional stability that would cost money to replace. Coverage needs should reflect real contribution, not only paycheck size. Term insurance is usually cheaper than permanent life insurance for the same death benefit because it covers a limited period and does not usually build cash value. The buyer is paying mainly for protection during the term. A young family may choose a 20-year term because the risk is highest while children are young and the mortgage is large. By the time the term ends, the children may be grown and the savings picture may be different. The young family example also explains why term coverage can be temporary without being weak. The need is intense during certain years, then may shrink as children become independent and assets grow. The death benefit amount should connect to real needs. A random large number may feel comforting but expensive. A number that is too small may leave the family exposed. Good planning looks at income, debts, dependents, time, and existing savings. The benefit calculation should also consider time. A newborn creates a longer support window than a teenager close to independence. A new mortgage creates a different need from a nearly paid-off home. Premiums depend on age, health, term length, coverage amount, lifestyle, and underwriting. A healthy younger person usually pays less than an older person with higher medical risk. Waiting can make coverage more expensive. Underwriting is the insurer's risk review. It may include health questions, medical records, exams, prescriptions, hobbies, driving history, or financial information. The insurer uses this to decide price or eligibility. One mistake is assuming employer coverage is enough. Workplace life insurance can help, but it may be limited, tied to the job, or too small for a family's real needs. Losing the job can also affect coverage. Employer coverage can be a helpful base layer, but it often does not travel with the person. A layoff, job change, or employer benefit change can remove protection at the worst possible time. Another mistake is buying only based on premium. Cheap coverage is not useful if the term is too short or the benefit is too small. The policy should match the years when people depend on the insured person's income. Term length matters. A 10-year term may work for a short debt or business obligation. A 30-year term may fit a young family with long mortgage and childcare needs. The right term follows the financial responsibility. Convertible term policies may allow the owner to convert to permanent coverage later without new medical underwriting, depending on policy rules. That option can matter if health changes during the term. Conversion options can be valuable because health can change without warning. A person who becomes harder to insure later may appreciate having a path to continued coverage, even if the permanent policy costs more. Conversion also matters for people who expect their needs to change. A temporary protection plan can become part of a longer insurance strategy if the policy allows movement into permanent coverage under clear rules. Renewal is different from conversion. A renewable policy may continue after the term, but premiums can rise sharply based on age. Buyers should not assume renewal will stay affordable. Beneficiaries must be kept current. A policy can be well designed and still create problems if the wrong person is listed. Marriage, divorce, children, death, or major family changes should trigger a review. Term life insurance does not solve every financial problem. It does not replace disability insurance, emergency savings, health coverage, or retirement planning. It is one tool for one specific risk: death during the covered period. The policy should be honest. Hiding medical history, smoking, dangerous hobbies, or relevant information can create problems later. Accurate answers protect the people who may need the claim paid. For families, the emotional conversation can be hard. Nobody wants to imagine death. But avoiding the conversation does not reduce the risk. It only leaves the survivors with fewer options if the risk becomes real. The emotional difficulty is real, but the financial need is also real. Families often make better choices when they discuss the uncomfortable scenario before grief, panic, or urgent bills are involved. A practical estimate starts with a question: how many years would people need support if the income stopped tomorrow? Then add debts, education goals, childcare, final expenses, and a cushion for transition. The estimate does not need to be perfect to be useful. It simply needs to be grounded in the family's actual obligations instead of a random round number. Term life works best when the need has an end date. Children grow up, debts shrink, businesses change, and savings can increase. The policy protects the vulnerable window without pretending the same need lasts forever. The goal is not to buy the biggest policy possible. The goal is to buy enough protection for the right years at a price the family can keep paying. That is what makes term insurance simple but powerful. The reason term life is often popular is that the need is usually temporary. A family may need heavy protection while children are young, debts are high, and savings are still growing. Later, the same family may need less coverage because the financial risk has changed. The stay-at-home parent example is important because unpaid work is still economic value. If that parent dies, the surviving family may need paid help for tasks that used to happen quietly. The death benefit should not be chosen by guessing. A parent might calculate 10 years of income, mortgage balance, childcare, education support, and final expenses. That estimate may not be perfect, but it is better than choosing a number because it sounds large. Policy ownership also matters. The owner controls beneficiaries and changes. In many simple family cases, ownership is straightforward, but business planning, divorce, estate planning, or trust arrangements can make ownership a serious decision. The best term policy is the one that is still in force when the family needs it. That means the premium must be affordable long-term. A huge policy that lapses because the buyer cannot keep paying does not protect anyone. A well-chosen term policy should feel boring after it is purchased. It sits quietly in the background while the family builds savings, pays down debt, and moves through the years when protection matters most. The right policy should match the family's real timeline, not fear or guesswork.